In today's video, we focus on reducing the amount of taxes you need to pay this year by maximizing contributions to workplace retirement plans. We'll take you through two examples where physicians really maximized their workplace retirement plan contributions to not only save money on their current taxes, but also better set themselves up for an excellent retirement. Hello everybody, and welcome to Wealth Matters for Physicians, powered by Altfest Personal Wealth Management, the channel that provides key investing and personal financial planning insights to physicians to help you optimize your finances and achieve your key life goals. My guest today is Steve Novak. Steve is a CPA, a CFP, and has an MBA from New York University. He's a senior financial advisor at Altfest Personal Wealth Management, where he advises physician clients in all areas of their personal finances with an expertise in tax-saving strategies. Well, thank you very much, Steve, for being with us on Wealth Matters for Physicians again.
Thank you for having me, Michael.
Great. Well, let's get right into saving taxes in the current year and also increasing quickly the amount of assets in retirement accounts for retirement readiness by maximizing pre-tax retirement contributions. I think that you have some really good examples of physicians who are doing these things in different types of work environments. So can you take us, I think the first example has something to do with a physician who works in the public sector. Is that true?
Yes, it is. In fact, it's a person who works for a hospital that has both public/private. Please, should put up the slide and we'll discuss the scenario.
Sounds good.
So if you look at this slide, you'll see this person works for a hospital and a public entity. Their total salary is $500,000, but that salary is bifurcated between two pieces. Most people who work for the hospitals and public sector have the ability to get a 403B and a 457. This person also has the ability to get a 401A. So let's talk about what these options are and exactly how that is to try and maximize the scenario of the income that they get. The 401A is a set amount that will come in. From the hospital piece, or the more private side, 12% of the person's salary will go in. So in this one where he's earning $300,000, $36,000 will be contributed by the employer. On the public side, you'll see there's 401A where there's two pieces. The entity, the employer, will put up 8% every year, which is $16,000. And the employee, for his side, will put up $12,000. These are non-optional. They must put this amount in. That's the minimum. A normal 457 plan would be on the public side, and in this one, it's the public side, usually paid for highly compensated employees that they want to provide this benefit, so they will want to stay in the public sector as opposed to go into a private sector where they can have some form of cash benefit plan or defined benefit plan, and we'll talk about that in the second question in a sec. But that is a cash withdrawal, just as if you had a 401k or 403b, up to $30,000. That is owned by the public or private hospital and is subject to risk if anything were to happen. In this scenario, this person works for New York State Hospital, and this is owned by New York State. So the risk is minimal. As long as New York State has the funds to pay it, they'll be fine. The unique piece of this scenario is the 403B in the private hospital side. There was a voluntary and involuntary piece. The voluntary piece is the standard $30,000. Sorry, I failed to mention this person is over 50, so it's $22,500 this year plus the $7,500 catch-up, and that's how all these $30,000s are being calculated. That is the same as someone working and having a 401k or 403b, all the same. The involuntary piece is the unique piece. I've only seen this a few times. The involuntary piece will allow you to maximize what amount someone could contribute this year. And by saying that is between the employee and the employer side. But the employee is paying both pieces of it. They must elect this before they start working. It is effective for every year they work going forward. So my client was concerned that what if he needed to stop this and he didn't have the funds to do this. For this year, the standard maximum amount is $66,000 for an employee under 50 and $73,500 for the employee who's 50 plus. And that's how you get the $30,000 plus the $43,500. Those two numbers combined to the $73,500, which I just mentioned. How I convinced the client to take this on is if he had a cash flow problem and he needed to reduce his contributions, he could reduce his contributions to the voluntary and the 457, and those two total $60,000, which is more than the involuntary piece. He had a habit of maximizing everything he contributed, and that made him feel comfortable that he had this $30,000 or $60,000 leeway that he can go back and forth. But as you can see, if you look at the totals here, $52,000 was going to be contributed by his employer, and $115,500 he would contribute out of his salary of the $500,000, netting him $167,500. This was a 3-year contract that he had, which basically, not adjusting it for inflation, would allow him to put away $500,000 of his salary, or 1 year basically, of the next 3 years tax-free into this account.
Thank you very much, Steve. I think that was an example that was very interesting to our physician audience. Your second example, which I think is also very interesting, is about a group of physicians who are running a small private medical practice. Can you take us through how they're able to maximize their contributions?
Sure. And as I mentioned in our prior question, talked about cash benefit plan. This slide that you can bring up right now has the advantage of allowing a cash benefit plan. So in the scenario here, the idea is to maximize the amount that is being given to the principals or the owners of the company while staying in line within the discrimination requirements, so they don't have to pay penalties, which can add up. In these scenarios, I think it's $100 a day per incident per day, with a maximum like $50,000 a year. So it can add up to some serious consequences. So in this scenario, I have 4 owners, 2 of which are 50 and older, and 2 are under. They're all earning the $305,000, and that is chosen because that's the maximum amount that can go to that contribution. After that point, there's no additional benefit to the defined benefit plan. So all the clients, all the owners are maximizing their 401k contributions with these are 2022 numbers, with the additional benefit if they're over 50. You can see that the employee pieces, whether the highly compensated employees or the staff employees, have no 401k contributions. That's because it doesn't matter. That money would come out of their salaries, and it's not part of this overall calculation showing how much the firm would need to contribute. The second piece is the profit sharing. Last year, and I mentioned the last question, this year it was $66,000 or $73,500. Last year, instead of that number being $43,500, it's $40,500. So all the owners are getting the maximum amount. 3% is being contributed to the highly compensated employees, and 7.5% to the lower end employees. The threshold for that in 2022, I believe, was $130,000. But this is the bigger benefit that we're trying to do. You would need an outside actuary or third-party administrator to provide you with the calculation for the cash benefit. The cash balance that's being contributed, you can see here, is based on age. The owners who are older obviously can contribute more of their salary to it. The total compensation, as you see in the second to last column here, should not go over the $305,000, the maximum of the salary. It does because these are all the additions that we're seeing. And if their actual salary was different, we might be able to adjust that a little bit. But in this scenario, that total number should be at $305,000. We have kept the highly compensated employees out of this to help create make sure we stay within the rules for discrimination. And the staff employees, the 18 staff employees at the lower level, are each getting $1,000. Now, the important part of this is going down in the total column, total contribution column. You can see that approximately 90% of the total money, and it actually would be a little lower because the top one would be limited, but most of the money goes to the owners and not to the other employees, and you're allowed to do this as long as you stay within the guidelines that says that you're the third-party administrator. It keeps you going with non-discrimination. And this, again, allows a smaller practice to really compensate the owners by a great amount with huge tax savings and long-term benefits for their retirement planning.
Well, Steve, those are 2 very, very powerful examples how physicians who make very good salaries but are getting hit with a lot of taxes can kill 2 birds with 1 stone. by maximizing their contributions to workplace retirement plans, not only can they save a huge amount of taxes in their current year, but they can fatten up their retirement accounts much faster to get to financial independence and a nice retirement much sooner. So thank you very much. I think you've given the physicians some great ideas today.
Hopefully they enjoyed this conversation and are looking into this for their own benefit. Thank you very much for having me today.
Excellent.
If you'd like to discuss the information explained in today's video, receive a complimentary analysis of your investment portfolio or retirement readiness, or discuss any of your other personal financial planning areas with an Altfest professional at no obligation, please contact my colleague Jesse Freeling at 212-796-8732 or by emailing Jesse at his email address, which is also in the description of today's video below. If you like today's video, please click the subscribe button below and hit the bell icon to receive notifications each time we release a new one. If you think a fellow physician would find this video interesting or useful, please share it with him or her to help them optimize their finances. Lastly, as always, if you have topics you'd like us to cover, like or dislike certain things that we're doing, or have any other feedback, we'd love to hear from you. So please share your comments in the comments section below. Well, that's all for now, physicians. Thank you very much for being with us in today's video, and I look forward to seeing you in our next one. Until then, be well, and remember to keep on optimizing your finances, or let us help you if you'd like.